Let's bring on board then Rituraj Sinha is the Group Managing Director who's now joining in. I'm just going to delve straight into, your financial performance, and we have seen that on the back of contract wins, the margin trajectory has been strong. So take us through some of the big contracts. What is the outlook there? What is the kind of margin trajectory as well that you're penciling in, Rituraj?
Well, thanks for having me. SIS has had a fairly robust last few quarters, even in the face of a general slowdown environment that actually is demonstrative of the resilient nature of the business model that we have. We have consistently booked orders over the last few quarters. Even the quarter that we will report shortly has a very handsome order booking and revenue change. Where this comes from? Well, it is coming from across our security, facility management domains. There isn't any one single contract that moves the needle for SIS. As you know, SIS, almost with a run rate annualized run rate of more than 8,000 crore rupees in revenue, does not have a single customer that contributes more than 1%. So we have a very diversified customer portfolio, and that's also the nature of the industry by itself. It's highly de-risked from that perspective. But generally across the space, we believe that in FM we've seen good orders coming through from large corporates. We've seen good orders coming through from insurance. We've seen good orders coming through from banking. Even on the security side, I think we've had good orders coming from IT. So pretty solid performance that way.
Rituraj, Nikunj also joining in. Now markets always look at absolute performance, they always look at relative performance. So let me look at the peers here. One of your peers is Quess, other is TeamLease. One of the ways why Quess has grown is that they've acquired a lot of small companies, niche companies, and they've added to their top line. SIS has not made any large acquisitions, at least what I understand in the listed avatar. Will that be your strategy, that you will focus on organic rather than inorganic?
Well, that's been our philosophy for the longest time. SIS will not look at inorganic for growth numbers. That's not the way we look at inorganic. For us, M&A is more strategic in nature. We acquire because we want to pick up market share in a particular territory. We acquire because we want to fill up service portfolio gaps that we might have. We've acquired in the past to enter customer segments where we are not very well represented. But we haven't really acquired to sort of boost our growth numbers as such. And SIS growth has predominantly been organic, and I think that's also the right way to create return on equity, essentially. So, I mean, that's been our outlook, and that will continue to be so.
Look at a business like SIS. Will it be a cost-plus business? Will it be a business where innovation will happen, and as you grow bigger and as you become large, you will be able to morph into a solution company?
Well, SIS is already morphing into a solution company. Let me just explain that. You earlier talked about my peer set, and there are multiple layers in the outsourced services industry globally. Outsourced services industry as a basket starts out at a staffing level where you're just providing the manpower. Then it migrates to the service level where you are responsible not for providing the manpower but for the output of that manpower or the outcomes. That's SLA level contracting. And the third layer is the solutions layer where you're actually problem solving. You're using manpower, you're using technology, you're using software combination to solve problems in the most cost efficient manner. So I think SIS migrated from a staffing type solution to a service type solution before we went IPO. So we were a service company always. We are not a staffing company in any which way. None of our businesses do a single staffing contract. And the indicator of that is that none of our contracts are actually per head with a fixed rupee markup. That's not the way we work. In the last 3 years, SIS has started to migrate or transform from a service company to a solutions company by using more and more technology. whether it's drones, it's video analytics, it's AI ML, it's mechanized cleaning for railways, it's various other software platforms that we've done for oil and gas sector or for the warehousing and e-com sector. There's tremendous amount of solutioning that SIS has done. The share of solution revenue has picked up in the last 3 years considerably, and we believe that over the next few years it will continue to do so. So clearly SIS is looking to transform itself completely from a services company to a solutions company. Coming to the next point about how this impacts market share, etc. I mean, the best case in point, Nikunj, is that globally, if you look at, let's say, the US market, the largest security company there or security solutions company there is Allied Universal with 20% market share. In the UK, the largest security company or solutions company is G4S with more than 20% market share.
Sure.
All of Scandinavia,
Right.
Securitas holds more than 20% market share. So
Right.
in India, we hold 4% market share, and I think there's a big headroom.
Okay, so understanding now what the business model is, but Rituraj, you have managed to outperform despite the slowdown in the last 2 to 3 quarters. So what is the road ahead from here for your domestic business? Will we see the slowdown now eating into your financials, or are you confident that you can continue to grow at the pace that you have been?
So basis what I see right now in terms of order book and contracts continuing, I see no change for the financial year FY20. We will continue to maintain more or less the same growth trajectory. Even from a long-term perspective, in my last 19 years that I've been in this business, we've seen cycles. We saw the GFC and the slowdown after the GFC and other such instances that have occurred in the past. You cannot do away with your security because you're in a slowdown. You can't not have facility management services or hygiene services done because the budgets are tight. So in such instances, what happens is that you don't get reduction in demand. You get slower uptake. So far, our uptake has not been slower because there is a lot of market consolidation that we are seeing. The operators, as compliance pressure goes up about labor compliance, the customers are moving from less organized and non-compliant operators to companies like us. So that's sort of making good any kind of slowdown impact. And I think that's also the global trend. I mean, globally, 80% market share in the US and UK is dominated by organized large operators. In India, 40% market share only lies with large organized operators. So India, as the compliance enforcement happens, Indian market share will also consolidate. The share of large organized operators will grow from 40% to maybe a 50, 60, 70, clearly. And that hopefully will give us enough, buffer to continue to maintain this kind of growth in the near to mid-term.
All right, Rituraj, appreciate your time. Glad you could join us, and good luck for the year.